Good weekend. This is Doc Severson. I want to do a quick market minute on Sunday, the 23rd. Here's the S&P 500 daily chart, and what we're seeing is essentially a ascending triangle pattern, an ascending triangle pattern here, where we have a series of equal highs and a series of higher lows. So what this should do, and I put should in quotes, is it should break to the upside. And the measured move should be approximately the open end of the triangle, which is about 700 points. So if you do the math, according to chart pattern theory, we're going to be looking at something like 4,900 later on this year. The problem with that hypothesis is this market has not been doing what it's supposed to be doing. So we have typical things like this. We have a bull flag that sets up. I mean, this is almost a textbook bull flag that's set up, and we're not breaking to the upside. We're still finding ways to have disappointing news come in and torpedo the market. Now, you know you got something when you get bad news coming into the market and the market breaks higher anyway. We saw that for how many years in a row, right? So now bad news when it comes to interest rates are breaking the market lower. And I think we need another one of those bad news events to break the market lower, because the last time I saw a market acting like this was a few years ago. Let me show you what that looked like. All right, I'm going to take you back to 2015. We had the summer of 2015, the market wasn't going anywhere at all, just was absolutely flat, no volatility whatsoever. And this was very dangerous to trade something like this, especially if you're selling options. Well, we got our surprise to the downside in August of 2015. Honestly, don't recall what it was, and it doesn't really matter. But what we saw was eventually the price went higher from there, and then we had round two with a double bottom, and then we eventually recovered from there. And so everybody says, okay, we've just recovered from this big sideways pattern. Here we go, and the market wouldn't go anywhere. So here we are in the summer of 2016, still the same thing going on, and kind of analogous to what we're seeing right now. And then along comes Brexit. Brexit came in from left field, surprised everybody. The initial knee-jerk reaction was to the downside, and that led us to much higher prices down the road as the negativity got unwound to the upside. Well, guess what happened after that? We got into the fall of 2016, and the same kind of thing happened. Nothing was going on until we had the election in November of 2016, and then we took off for the following year. So we're kind of in the same boat right now. The market's going sideways. It's supposed to be breaking out, but it's not. It can't seem to get any kind of imbalance in supply and demand to form that upside breakout. Every breakout is being punished back down into the pattern. So we almost need one of these negative events to come along, shock the market, build up the negativity, and then have the bulls step in again, squeeze out the shorts to the upside. It's a time-tested formula, and it seems to work in these types of sideways markets. The other benefit to that would be all these gaps to the downside. All these gray boxes are downside gaps, and if we end up retesting 4,000 from above, that goes down to a 50% fib retracement, retest the 200-day moving average, fills the gaps, all kinds of good things happen if we end up going down in price first. So that's the deal. We should be breaking higher, but we're not. We may have to go lower first, one step back to take two steps forward. That's it for today's Market Minute. Thanks for listening.